So it's a nice time again. We meet for financial reporting. So we are going to do a question of receipting, that is August 2021 for published accounts. So to start with, we do the interpretations to the question, that is question 1B. Then we do the presentation of the statement of comprehensive income and the statement of financial position. So the first additional information was talking about the company had paid maintenance cost of 12 million for 3 months. So which means that per month, it was paying 4 million. From 1st September 2020, that is the case. So the invoice was posted on 1st September 2020 and included in the cost of sales. So this one, I said obvious that that amount, we have to remove it from the cost of sales for the 2 months, because our financial year was ending on September. So at the end of September, I think it started September 20, it was started September or 31st. September ends on 30th or 31st.
30th.
Yes, 30th September 2020. 30th September 2020. So 30th September 2020. So that is the period when our financial was ending. So it was starting on 1st October 2019. So they paid from 1st September 2020 for 3 months. So for maintenance contract, so a total of 12 million. So 12 million divided by 3, that is 4 million. So I'm writing in terms of thousands. So which means that for 2 months, that is for October and November, it was outside this financial year. October and November is outside the current period. So which means that is 8K. So 8K is a prepayment. 8K is a prepayment. 8K is a prepayment. So which means that this 8K was included under the cost of sales. So the total amount, remember, it was included under the cost of sales. So which means that we have to remove under that cost of sales. Then after that, there is additional information number 2. So additional information number 2, they were talking about a plant which was leased from 1st October 2018. So the rental repayment are 2.6 for 4 years, payable in arrears. So on 28 September 20, that is on 28 September each year, the interest rate implicit in the lease is 10%. Is 10%. So that one means that we have to do a lease amortization schedule. Lease amortization schedule to determine the interest and to determine the relevant liabilities they were supposed to make. So the obligations they are supposed to pay out of the risk plant. Out of the risk plant. So here we have the risk plant. The risk plant. So we have to do a risk amortization schedule. Risk amortization schedule. There is amortization schedule. Risk amortization schedule. So there is amortization schedule. So this risk amortization schedule, when you prepare it, you have to base your argument on the way they were paying this relevant rental repayment. So the rental repayments are 2.6 per annum for 4 years, payable in arrears on 28 September each year. So the interest rate implicit in the lease is 10%. So which means that the lease plant was acquired on 1st October. So lease the rental. So the rental repayment, that is, it's payable in terms of arrear, so not in advance. So in every year, they were supposed to pay 2.6 in arrears, which means that at the end of the year, at the end of the year. So what you do, remember that this starts 2018. So I have to write 2018 here. So which means that this is the year. So the first year is 2018. So which is fine. So the balance brought down the total value of the plant. The total value of the plant is the total value of the plant. So in this scenario, the leased plant was acquired on 1st October. The rental payment 2.6 for 4 years. Interest, so the interest rate implicit in the lease is 10%. So we have to go back to the trial balance and check if they mentioned about this leased plant. So they said that so the leased plant is this one. It is stated at 10,000, but they said that somewhere here, other than so they talked about finance risk. The finance risk payment is this 2650, which is the payment they are making every month. But now the obligation under finance risk is 55. So what I have to do, remember that this is the obligation they're supposed to pay. The obligation under finance risk, the amount they are operated to pay is 55. So the 55 is what I would start with. The obligations under finance risk. So the balance brought down there is 55. So when they give you all those figures, I have to use the obligation because the obligation is what they are supposed to pay. So 55 is what I will start with. Then after that, remember that now they will pay interest before they pay they will have to pay the interest before the rental repayment is made, because it was in terms of arrear. It was not like now the previous question we did, whereby it was in terms of advance. That is a advance. So here, the interest is at 10%. Interest is at 10%. So this is all about 550. Then they were supposed to pay an installment of 2650. So which means that the balance at the end is, so balance carried down. So the balance carried down. So when it is in terms of arrears, you always start with the interest, then you consider the installment. So you take 5,500, you add with 550, you minus the 2650. So this is 34. That is 34. So which means that in 2019, so 3,400. So 10%, 340. Remember 2650 is just paid annually. So 3,400 plus 340 minus 2650. So that is 1090. Then we have 2020, 1090. So this one will be 109. So 2650. So 1090 plus 109 minus 2650. So remember, this one is becoming even a negative. So which means that this amount was even paid before the end of the 4 years. The amount of 55, this amount was settled before the end of the 4 years. Because there I can see the balance by the 3rd year, it's a nil, which is a negative. That is why I never recorded anything. That is why I never recorded anything. So remember that our financial year ends on 2020. Our financial year ends on 2020. That is September. So we need to know the non-current liability and the current liability. The non-current liability and the current liability. So right now here, we have to base our argument most in these 2 years, 2019, 2020. 2019, 2020, because that is obvious the period when our financial year is ending. Our financial year ends on 30th September 2020. So the obligation which is paid within one financial year, the obligation which is paid within one financial year, within the 12 months, is what we call current liability. Then the one which would be paid after 12 months is what we call a long-term liability. So right now here, for the long-term liability, is this 1090? Is this 1090? So 1090 maybe it's the one which was supposed to be paid at the future period, because it's the balance we have in 2020. We add with the interest, then we pay the balance, but we have a negative amount by the end. Then remember that the total amount which was supposed to be paid from 2019 in the year 2020 is 3,400. This 3,400 is the one which was supposed to be paid in the year now, in the year 2020. But now we have said that 1090 would be paid in the future period. That is not within the year 2020. So we deduct from there. So this is in terms of arrears. This is in terms of arrears. So that is 2310. That is the 2310. Then after that, we have additional information number 3, where they are talking about inventory. So what you need to know is that inventory is measured at the lower of cost and the net realizable value. Inventory is measured at the lower of cost and the net realizable value. So which is under International Accounting Standards 2. Which is under International Accounting Standards 2. That is why I went ahead to share some notes to your WhatsApp group. There's some notes I shared to your WhatsApp group concerning this aspect of inventory. So under the inventory, there's these notes I shared. Scope of the term inventory. Inventory includes assets held for sale in the ordinary course of the business. That is a finished goods. Remember that the inventory includes the assets held for sale, the one you held for sale, the finished goods, assets in the production process, for sale in ordinary course of the business, assets in the production process, which is work in progress, and the material and supplies that are consumed in production. So measurement of inventory, I've said it's measured under International Accounting Standards 2. It's measured using International Accounting Standards 2. So inventory are required to be stated at the lower of cost and net realizable value. That is under IS2. Lower of cost and the net realizable value. So cost should include the cost of purchase. So that is transport, handling, and tax. Cost of conversion, which is manufacturing overheads, and other costs incurred in bringing the inventory to their present location and condition. So inventory cost should not include abnormal waste, storage cost, administrative overheads, selling cost, and similar costs. So for disclosure requirement, you can read more. For disclosure requirements, you can read more. But now my main focus is on this measurement. Cost should include the purchase cost, cost of conversion, and other costs incurred in bringing the inventory to the present location and condition. So inventory costs should not include abnormal waste, storage costs, administrative overhead, selling costs, and similar costs. So for the others, I've said that you read more on that document. So let's now check on that additional information, which was concerning inventory. So this additional information, which was concerning inventory, they said that on checking the inventory figure, it was discovered that an item of inventory with the following valuation was omitted from the inventory valuation that had been used in the trial balance. So on checking the figure of inventory here is under the trial balance, 20,200. So the figure of the inventory here is 22,200. But they said that on checking the inventory figure, it was discovered that an item of inventory with the following valuation was omitted from the inventory valuation that had been used in the trial balance. So in short, we have seen that the inventory is measured at the lower of cost and net realizable value. So first, the replacement cost is supposed to be part of the inventory. Replacement cost, you add it back to the figure of inventory. So inventory, which you have is inventory is 20,200. So which means that we have to add the replacement cost, which is supposed to be part of the inventory, part of the stock. So 20,200, you add the 40. So this one will be 20 to 40. Then even if I compare with these costs, the other costs, you will find that the 2,240 will remain to be the lower. After adding the 40 back to the inventory, then I compare my relevant value of the inventory I have with these costs and the net realizable value. So you will find that the 22,240 is the lower among these figures. So which means that as per IS2, inventory is measured at the lower of cost and the net realizable value. So which means that obvious out of the three costs, 48,000, 45,000, and the 20 to 40, 20 to 40 will remain to be the lower. So 20 to 40 will remain to be the closing inventory. 20 to 40 will remain to be the closing inventory. I think that was the only challenging additional information in this paper. Additional information number 2 and 3. The others are just direct. The others were direct because like number 4, it doesn't require any working. They said that database cost rates the development of a new database for the company, which the management consider should be included as intangible assets. So when you go to your non-current assets, I said the database cost will be recorded as an asset, as an intangible asset, as we have been told in addition information number 4. There's nothing there to work out on. Number 5, included in the trial balance represents what? Included in the trial balance under the land and building is 4 million for the cost of land. So we have land. So its cost, you have been told is 4 million. So let's say 4,000. You have been told is for the 4,000. It's 4,000, which is not being depreciated. And obviously we know that land is never depreciated. So the land had a market value of 4.8. So which means that you have a market price, a market value of 4.8. So this is the value at which this land can be stated currently. But its cost in the books, it was 4,000. So which means that it has revalued by 800. So there's a revaluation gain of 800. So the difference between the two, that is the cost and the market price. So which means that that is a revaluation gain. It will be part of other comprehensive incomes under the income statement. Under the income statement, you would have to use it as other comprehensive incomes. As other comprehensive incomes. So after that, we go next to depreciation. Now, right now, depreciation, you could have never missed that. I have said the only additional information maybe you could have missed on this question is additional information number 2 and 3. The others, even number 1 was easier, number 4 is direct, even number 5 is direct. Number 6 again is direct because depreciation of building and motor vehicle, 5% on straight line basis, which means that 5% on cost, 5% on the cost. So cost of the building is, so you go to your trial balance, you check the cost of the building. So remember that the land and building was 12,600. And you were already told that in note 3 or 4, note 5, that that of the rand is 4 million. So which means that building is, so the total for rand and building is 12,600. You have been told in the additional information that the one for rand is 4 million. So you deduct, you wait 8,600 is for building. So that when I will be doing my depreciation on building, so you take your 5% of the 8,600. I think you are seeing where the figures are coming from. So this 430, and when we will be classifying the expenses, you have been told that right now that one, for that you take it to where? You take it to administrative. So remember that whoever who has not seen where I took, where I got 86 from, it's only that this total amount, rand and building here, is 12. But in the additional information, you have been told that rand, its cost was 4 million. You were told that its cost was 4. So we deduct to get that of building. This 4 million is here for rand. So the 4 million is this one here. Then let's go to motor vehicle, depreciation, reducing balance. So which means that motor vehicle, its cost was, you minus accumulated depreciation, then you multiply with depreciation rate. Simple like that. You know, reducing balance. Cost, you minus accumulated depreciation, then you multiply with the depreciation rate to get the depreciation for the year. Do that. So that is this is 18,400. So let me clear this. Yes, that is, you can see now it's 18,400. So 18,400. Remember, we are doing depreciation. So 18,400 minus 64. What are you getting? 18,400 minus 64,100.
12,000.
Times 25%.
3,000.
So that 3,000, when I will be doing my classification of expenses, it will go to the distribution. It will go to distribution. Is there another working which is remaining before we classify the expenses as per the functional heads? So current year tax was estimated to be 3,800,000. 8,000 of the trial balance relates to over provision for the previous year. So for you to understand more about this tax, we always said that for you to compute for the income tax, for you to compute for income tax. We always say that current tax, we start with current tax plus minus increase or a decrease. So increase or decrease in deferred tax. Increase or decrease in deferred tax. Increase or decrease in deferred tax. Then we add tax under provision. We minus tax over provision. We minus the over provision. Here the examiner was a bit fair. He told you that the 8 million represents an over provision. In some questions, you will never be told. You have to be told that the current tax may be in the trial balance represents an under provision or over provision. It's according to you to use your own knowledge. To use your own knowledge to determine if it's an over or under provision. But obviously, you know that if it's an over provision, it's an income. Which means that if it's in the trial balance, obvious, it will be on which side? Incomes are debited or credited? Credited. So under provision is an expense, which would be debited. So once you are told that current tax in the trial balance represents over or under, you just check that current tax in the trial balance. It's on the credit side or the debit side. If it's on the debit side, it's an under provision. If it's on the credit side, it's an over provision. So on this scenario, there was no much of the information. They just said that the current tax. So these are about the current tax is 3.8. We just minus the over provision. So we get the 3,000. 3,000 or what? Not the 3,000 because they said, remember here, this 8,000 in the trial balance. So which means that in the trial balance, this amount would be 8 million. Remember that our question is in terms of millions. So it's just checking. We check 8 million. We take 3,800 shillings minus 8, just 8, not 8,000. That is how it can be in terms of thousands. Because the other one is 3.8 and the other one is 8,000. So this one would be 3,800 and the other one would be just 8. So if you minus 8, it would be 37.92. So that is the tax, 37.92. So after we are done with the additional information concerning tax, we continue with the others. So number 8, they are saying that the loan were issued on 1st April 2019. So the loan notes were issued on 1st April 2019 under an agreement that provides for repayment in 2022 at a substantial premium. The loan notes effective interest rate is 8.5. So here we need to do some working on this loan so that in short we determine the relevant value of the loan. We determine the value of the loan and we determine what? The balance. The balance of the loan. So the balance of the loan. So the value of the loan was, my good students, the value of the loan was, the value of the loan was, I'm just asking, what is the value of the loan in the trial balance? There's no computation I'm telling you to do. Just going to the trial balance and telling me the value of the loan. So the 10% loan stock. So 10% loan stock is 2,600. That is 2,600. 10% loan stock, 2,600. So now here, remember that these are about the contractual rate. 10% is the contractual rate. But now when we are charging interest on this loan, we have to be very careful. They went ahead to say the effective interest rate is 8.5. So which one can I use? Is this market interest rate or the contractual? So when you are given, when you are provided with both the contractual is right now the 10% at which the loan was taken, and you are given the effective interest rate, the market interest rate. Obvious, this effective interest rate, the interest rate which is prevailing currently, will obviously prevail. So the contractual will not be used here. So which means that the interest which would be charged on this loan, interest will not be on 10%, but the 8.5, which is the current effective rate. So now we will not use the contractual. The 10% will not be used. So if you take 2,600 times 8.5%, you get 1,751. So you have to deduct the loan, the interest which was already paid, interest paid. In short, remember that this loan is this entity which received some more. So when they pay, they are the one who are paying the interest. So we have determined the total interest they were supposed to pay, then the one which they have already paid. So which interest have they paid? Loan stock interest paid. They have paid 206 already. This one, loan stock interest paid, the one which is on the trial balance. So here deduct 206. So finally, the balance of the loans is supposed to be, so 2,600 plus 1,751 minus 206. So you get 22,145. You get a 22,145. So that is okay up to that point. Up to that point, that was the last additional information we were supposed to do. So the next thing we have to do now is the statement of expense allocation. So first, as per the trial balance, so the balances as per trial balance. So the cost of sales as per the trial balance. The cost of sales as per the trial balance, I can see here we have 117, 250. 117, 250 there. Cost of sales. What about admin? 13. We have 13,750. Then we have 97.50 for distribution. We have 97.50. Then now, next we go now to the additional informations. Additional information number one was concerning maintenance costs. We said they have prepaid for 2 months. They had prepaid for 2 months. I think we said that. We did the working number one. We got 8,000. Because our financial year was ending 30th September, of which they paid from 1st September for 3 months. So for the 2 months which were outside this year, it was a prepayment. And they said that this amount was included under the cost of sales. So that one we have to deduct. Prepaid amount. The prepayments You always know that prepayment you deduct from the relevant expense. If it's accruals, you add. If it's accruals, you add. The next, remember that there was some omitted closing stock, which we added. The one which I said, which was supposed to be part of the inventory. The replacement is supposed to be part of the stock. Replacement cost. So the replacement cost was supposed to be part of the inventory. That is why I added back this 40. So which means that it was omitted. This one was omitted. So obviously it has to affect again our cost of sales. Omitted closing stock. So we add here. We add or we subtract. It was supposed to be subtract because we added under the inventory. We added under the inventory. Here we deduct. Because obviously you know that to get the cost of sales, we always say opening stock plus purchases minus closing stock. So if it was omitted, we don't have to add, but we deduct. You know that cost of sales is opening stock plus purchases minus closing stock. So stock is deducted. Stock is deducted. So another expense, we have depreciation. I think that is where we head to. Because database, they have said that this one we never record as an expense, but we record it as intangible asset. Number 5, it was revaluation gain. That is other comprehensive income. That is other comprehensive income. So we have depreciation of building and motor vehicle. We did that. We did depreciation of building and we did the depreciation of motor vehicle. So the depreciation of building will go to the admin and the motor vehicle will go to distribution. So which figure we arrived at when we did this? I think we did that working. We did those 2 workings. So for the building, we got 430. And for the motor vehicle was 3,000 after using the reducing balance method. So we have classified according to the way we are told to do. Then there's one expense which we ignored under additional information number 2, under the risk plan. Remember that it was having how many years? An economic life of 4 years. It is having an economic life of 4 years. And the total value of the plant was, other than the obligation which they were supposed to pay, the total value of the plant, the risk plant, was stated at what? Remember the number of years is 4 years. The economic life which you are told there is 4 years. So which means that the risk plant was at what value? Other than the obligation which we just did on how they were supposed to pay, the risk plant was stated at 10,000. So to remember that your depreciation, you have to use the total value of the plant at which it was stated. You divide with 4 years. So if you take 10, you divide with the economic life, that is 4. You get 2,500. You get 2,500. So depreciation of the risk plant, that is 25. So you classify under cost of sales. When you are not told mostly on how to classify those depreciations, mostly you classify them under the cost of sales. Maybe when you are told to classify them under admin, you do that. But most depreciation is classified as a cost of sales item. But again, even if you classify under admin, you cannot be penalized on that. You can't be penalized on that. So up to that point, you can give me the totals. Provide the totals. So someone to do for the cost of sales, another student to do for admin, and another one to do for depreciation. Martin, cost of sales, Agnes, admin, Joy, you do for the distribution.
Distribution, it's 12,750.
12,750. What about, so the first one I have 111.
Cost of sale,
Mhm.
111, 710.
Admin,
14,050.
14.
14,180.
That is 14,180. So which means that there was one expense again we had to classify under that, under the admin. There was one expense which I was supposed to classify there. There was this expense here, which I've just remembered that I was supposed to classify under the admin. So let me show you which expense is that one. So there was additional information number rust, which we never captured. So they said that some years back, Samoa Limited gave guarantee, securing Mirandi Limited overdraft. So when you guarantee someone, remember that you are right now the one who is supposed to pay. If that person defaults to pay, that relevant liability. So this Samoa Limited stood for Mirandi Limited to take an overdraft. It has recently been reported that Mirandi is in financial difficulty, and the company, and at the company's year end, the overdraft stood at 100. Who will pay this amount?
Samoa.
So this one will be an expense to Samoa. It will be an expense to Samoa, and at the same time a liability. So it's like now we have a provision. We have a provision, and you have to put it under admin. So your answer was 14,180 plus 100. It would be 14,280. 14,280. That is 14,280. So then after that, try to mute your mic, Joy. So after that, we have one of the expenses which we have not classified well. So the finance cost. So remember that there was that one on the loan stock, the interest on loan stock. Remember that I said there was that 10% and there was 8.5. So this one was the contractual, 8.5 was the current interest rate, the effective interest rate currently in the market, which I said that one is the one which prevailed. So it was 8.5 times the total value of the loan, which was 2,600. This one we arrived at 1,751. This is something I explained. That is what I'm just writing. Then from the RIS, so interest from RIS, so we call it finance RIS. From the finance RIS, from that finance RIS. So from the finance RIS, I remember that in 2019, which interest did they they were supposed to pay in 2019. So obviously it will be this initial amount here, 550. That is what will be paid in the next financial year. That is 2019. So we add the two. So 1751 plus 550. So that is 2301. So from there, even if after doing that, some of the challenging additional information, but now when you present now the statement, you will realize that most of these things, some of them were a bit direct, some of the few were a bit direct. So these are about for the year ended 30th September 2020. So we have the sales. Sales, this one, it doesn't have any working. Or we call it turnover. So our sales was our revenue or turnover. So you can see our revenue was 156,000. 156,000. This one revenue 156,000. Then you raise the cost of sales. That is from the workings you have done. $117,710. So you get your gross profit. So after the gross profit, you add some incomes. So which are some of the incomes we have in this question? Which are the incomes we have here? We have investment income. Investment income. So that is 350. The 350. The last item down there. Then after that, we raise expenses. We raise some expenses. So expenses is just admin and selling and distribution. So admin, then selling and distribution. Then we consider finance cost. So it come here and say raise expenses. So we have the one for admin. We have the one for distribution. So the one for admin is 14,280 and the 12,750. This is what you have computed already. So that we have profit before interest and tax. So interest is the finance cost. Interest, this one, profit before interest and tax. So 2301, we have just determined a few minutes ago. So we have the profit before tax. We raise the income tax. We raise the income tax. So income tax we did, early enough. Remember that we got 3792. So profit after tax. Then after getting profit after tax, remember that we have to raise or we have to add. Let me add first. Retained profit. Because on this question, we are not supposed to prepare statement of changes in equity. So we can add retained profit here. Brought down, then you raise dividends paid or proposed. Dividend paid or proposed. So for the For the retained profit, it's here 2100. Then dividends paid or proposed, the equity dividends paid 37.94. You can see them. 37.94. So that you get the retained profit for the year. Retained profit for the year. Retained profit for the year. Then after that, now we have to add other comprehensive incomes. Add other comprehensive income. So that income which is not directly related to the business operations, and that one mostly is all about the revaluation gain. It's a gain, yes, but it's not a gain which we got directly from the normal business operations. So the one which was 800, the one for rand was revalued. Up to that point, we have total comprehensive income. We have total comprehensive income. Under the statement of financial position, the main thing you have to do there is classification of tangible long-term assets, so that you have one figure. So we have things like rand. Remember, rand was revalued because its market price currently is at a different figure than what we know in the trial balance. In the trial balance, it was 4,000. That is what we are told in additional information number 5. Included in the trial balance under land and building is 4 million for cost of land, which is not yet, which is not being depreciated. So rand has a market price of 4.8. So 4.8 is the new figure currently at which rand can be measured in the market. That is why we said it was divided by 800. So which means that here we record 48. 48. Then what about building? So building. So remember that the rand and building, the total value was 12.6. So which means that if you minus if we minus the cost, we remained with 86 for building. Because in the trial balance, the total value for rand and building was 12,600. But the one for rand, the cost was 4. So here we have buildings 86. So we minus accumulated depreciation, then depreciation for the year. Accumulated depreciation and depreciation for the year. Remember that the building was being depreciated. So accumulated depreciation is accumulated depreciation. It's here. So building 27. So we computed the depreciation for the year for building.
Yes.
Depreciation for the year was?
For that.
So you minus that for that. So this is accumulated, then this is depreciation for the year. So what are you getting?
5470.
5470. Then after that, there was that motor vehicle. So motor vehicle, the total value was 18,400 from the trial balance. Accumulated, I can see 64. Depreciation for the year we got is, because I've taken the value minus accumulated depreciation.
3000.
So you deduct that 3,000.
9000.
So you remain with 9,000. Then finally there was a risk plant. Risk plant, initially the total value was 10,000 from the trial balance. Then accumulated depreciation is given in the trial balance. risk the plant, 25. But the depreciation for the year was 25 again. Because we took, when I was determining the depreciation for risk the plant, I divided 10,000 with how many years?
4 years.
4 years, the one which is given in note 2. The RIFE, the economic RIFE. This one will just remain to be 5,000. So add this. So this one will be 24. That is what I'm getting as per my calculator. 24 to 70.
Yes.
So next we talk about some more remittance. Statement of financial position. As at 30th September 2020. So what I will do, I will start with non-current assets. So for the non-current assets, we have the PPE, 24 to 70. We have the intangible assets. Which is the intangible asset I will record here?
Database.
Database. They said that. I think now I can see the students who are careful of what we are doing. So they said that from the additional information. Number 4. They said it in number 4. So the database value is 308. Then we have the current assets. We have the current assets. So for the current assets, we have the inventory. Our closing inventory in the trial balance was 2,200. We added the 40, which was omitted. The one concerning replacement cost. The one concerning replacement cost. So you get 20 to 40. Debtors or receivables. So never worry, we are almost done. So today we'll finish area. So the receivables is 16,400, this one. Receivables, 16,400. There was some bank. So the bank balance is in the trial balance, 2,750. Any asset which is remaining, you can see there. There was a first item there which I never recorded. Investment at fair value. Investment at fair value. That is our current asset. Investment at fair value. The 5,000. Then finally there was some prepayment. Which prepayment? Which is
Maintenance cost.
yes, maintenance cost. So the total amount is
8,000.
It was 8,000. So we have the total assets there. So the next thing is all about, the next thing is concerning equities and liabilities. So equity and liabilities. So for the equities and liabilities, ordinary share capital. I can see the ordinary share capital of 20, 200 from the trial balance. I think you can see that. This one here, ordinary share capital, shillings 50 each, 2,200. 2,200. Then we have revaluation. Which revaluation would I record here?
Valuation on rand.
So the rand 800.
Yes.
The one for rand. Then retained earnings was 98 words. From the income statement we prepared. The one I said I needed 9823.
2823.
9823. All right. So non-current liabilities. Talk about non-current liabilities. So just yeah, so for the non-current liabilities, there was that 10% loan stock. So the balance was the balance of the 10% loan stock. We did a working on that. There was this working we did. 22, 145.
Yes.
That is 22, 145. So that is the working we did. Then there was under the risk rental, under the risk plan, I said obligation, under finance risk, the wrong term was supposed to be 1090. I think you can go and check on that, the one which I interpreted about risk plans. Then current liabilities. So for the current liabilities, we have payables. So payables from the trial balance is 16,700. Then now, other than from the trial balance, we have various current liabilities which are in the question, but under the additional information. Obviously, you know that current tax is a current liability. Deferred tax is an uncurrent liability. But here there was no deferred tax. There was only current tax and some over provision, which we deducted. But now the current tax they were supposed to pay, which is estimated. Number 7, that is, current year tax was estimated to be 3.8. Estimated, sometimes they say that is to be provided. So tax payable, the one they were supposed to pay, 3.8 in the current year. Then there was obligation under finance risk, the wrong term. Obligation under finance risk. This one we did from the working. We arrived at 2310. We did those workings. We did those workings. We arrived at 2310. So this one from the risk amortization schedule. So what have I not recorded? There was that provision, which we said it's an expense. The provision for overdraft, or D, the 100. You have to record as a liability and at the same time It was an expense. And again, it's a liability because they have not paid that. It has not been adjusted. It was under the additional information. Anything under the additional information, it has not been catered for. So we have to record as an expense and at the same time as a liability. So total equity and liabilities. Total equity and liabilities. So what are you getting here? It is in agreement, that is assets and equities and liabilities. Total assets,
76,968.
so 76,968. What about down here?
76,968.
68.
So that is okay. That is how you were supposed to do this question of RCT. It was a very simple question, or it was a difficult question. Maybe in that paper, this is the only question I can say a bit, it was challenging, a bit. For the others, they were just direct. Even we did them in class. For the group accounting, they copied from 2015. For insurance, they copied it from 2014. Then there was another question for dissolution. It was something which we had already predicted that it was supposed to be there. So the only question which they brought may be in that previous sitting, which we never looked at mostly, maybe. Specifically, I mean, the question itself is maybe this one. But again, I had done the necessary preparation for the students. They had the information that when you are doing a question for published, these are the rules you follow for income statement. These are the rules you follow for the statement of financial position. Even this one, it has a lot of free marks. A lot of free marks, starting with intangible, going to the receivable, going to bank, going to investment, going to ordinary, going to payable. This question, even it was having you are not even supposed to do those. You can even present if you are keen enough. Maybe whoever who did this receipt in paper. If you were keen enough, this one you could have even scored without the workings. I have wasted time because if I count these marks which I have recorded without any working, there are more than 8. So this is intangible number 1, receivable number 2, 3 for bank, 4, 5. We have 6. Then let's say, for example, tax payable, tax payable, that is what is supposed to be done. Even this revaluation is something which was direct. So, and that one, it's not that I'm using my own way of marking. It's the custom way of marking.